Okay, welcome everyone to our last masterclass on Social Security from Income Lab. Well, everyone's getting in the room. Maybe share with us the best the best trip you took this summer, if you took one. I mean, it could be to the park down the road if you want. So, what kind of good things happened for you this summer? I'm in Colorado, and I would say our best was we went for the 4th of July. We went to, well, people pronounce it different, Buena Vista. Saw some amazing fireworks, parades, hanging by the river. Can drop that in the chat. Whoa, Scotland. Okay, a lot of people went a lot farther than I did. 2 weeks in the Outer Banks sounds pretty great. U.S. Open, nice. Yeah, I'll take fishing. That sounds good. All right. So as people are still kind of filtering into the room, we'll do a little bit of housekeeping. So as I said, this is the last of a 5-part masterclass series. The recordings and materials for all of the previous sessions are available. We'll drop that in the chat as well. And please do take a look at them. What I love about this series is we actually did very different things in each of these sessions. So a mixture of kind of new ideas with some of the more technical things that might be review for many people. So hopefully this will be kind of an evergreen resource for those of you, if you're ever looking for, wait, what were all those complex things about, survivor benefits and divorce? Check out session 3, right? Go back to it. So we'll have all that available for you. We may even, revisit some of these topics in the future since we do run more research-oriented webinars once every month as well in our Retirement Income Intel series. But today we're kind of going to try to wrap the whole thing up by having an advisor panel talking with clients and prospects about Social Security. And we have a great panel today. And we'll try to leave some extra time for questions as well, so that if there are things, even from previous sessions, that you want to make sure that we can address, we'll do that. So the reason that we wanted to finish the masterclass series with this topic is, it's great to know all sorts of things about Social Security, to know the intricacies, to, go really high level and talk about, psychology and so on. But in the end, this is one thing I love about financial planning is it really is a mix of theory and practice. And practice is where the effect is actually had. So if we can't bring these things into practice, it's really just theoretical. So that's what we'll be doing today. This session, I believe, also has CFP credit, so hang around afterward, put in your CFP ID. You do have to be on for 50 minutes live, and your AI note taker does not count. If you have questions, and like I said, we're going to try to leave plenty of time for that, please put those in the Q&A, not in the chat. You're welcome to use the chat, but it's much harder to monitor, whereas the Q&A, we can track them, and you can also upvote questions, so we'll know which ones to try to get to first. Typically, we do not get to all of the questions, although we will try. So with that said, go back to our main page here, and we're going to introduce our panelists for today, some of whom you know already and some of whom are new. We have returning Mike Kothikoda from Wolfbridge Wealth, as well as NYU and Columbia, Derek Tharp from Conscious Capital and Income Lab. And we have our 2 new panelists today, Matt Glass and Jeremiah Nolan. And we're going to go, first of all, just have each panel member tell us a little bit about themselves and their practice. So maybe we'll start with you, Matt, since you got that great background there.
All right, man. Trying to butter me up. What's going on, everybody? Glad to be here. So my name's Matt Glass. I am located in Greenville, South Carolina. I've been in the financial services industry for about 10 years. About 2.5 years, we kind of shifted directions to make Social Security our main focal point as far as the value add, prospecting, seminar based, and it has completely changed our business. So happy to be here. I've got a daughter who is 8, and we do a lot of traveling. But other than that, all I do is work, spend time with her, and then work some more. So happy to be on here.
Thank you for joining us, Matt. Jeremiah, let's go to you.
Absolutely. Hello, everyone. Jeremiah Nolan. I'm in Central Alabama. I've been in the financial services industry for well over 20 years. About 5 years ago is when we kind of shifted more into the income planning, retirement, specialist. I like to tell everyone we're a retirement income specialist, and part of that means to how do we optimize and maximize your Social Security, because it's one of the most tax efficient, cost of living adjusted, sources of retirement income that you can have. And so by starting with Social Security, optimizing it, we then can backfill with all of everything else. And so we definitely make that a heavy focal point. I was honored to be the 2023 National Social Security Advisor of the Year. And so it's an honor that we hold, to the highest level, and really, really speak to our prospects and clients about how to optimize the Social Security and not leave 6 figures of money on the table if you don't have to. And so that's what we're trying to accomplish. I'm also a father, a husband and father. I've got 4 children. They range from 18 to 5, and so we stay busy and active, and kind of the same thing. We're excited about football season getting started. That's everybody says I need a hobby. My hobby is my children and Auburn football. So let's do it.
Awesome. All right, Mike, also in the South. We're very heavily represented today.
So I'm based out of North Carolina. I live in a town called Wake Forest, not to be confused with Wake Forest University, which is in Winston-Salem, which I know is very confusing for a lot of people. But that's kind of the case. Actually, Wake Forest University is Southeastern Baptist Seminary, so which used to be Wake Forest. I've been financial planning for 20 years. I teach, like Justin mentioned, I teach at Columbia in their CFP board registry program. I'm an Army vet. I have a 25-year-old daughter who's working on her doctorate in criminology at the University of Maryland. So I can tell you guys who have young kids, it doesn't stop at 18 like it did for us. So buckle up.
Nice. All right, last but not least, Derek.
Yep. Derek Thorpe. I'm located in Portland, Maine, and involved here on the Income Lab team, but also have my own RIA. Teach at University of Southern Maine. And Social Security for me, I've been doing for a while now, a number of different like workshops and things like that through just local uh, universities, libraries, things like that, where I can go and present on Social Security. Also do taxes and retirement, and some of those other topics, not just Social Security, but definitely is a big one. And I think going forward will be even more of a focus of mine.
Awesome. Thank you, everyone, for being on the panel and telling us a little bit about yourselves. I thought I'd start kind of high level, and actually, Jeremiah, I think you already addressed this a little bit, although you may have some more things to add, which is just to the extent, well, two things. What role does Social Security play in your practice? And for some of you, as Matt said, you've made it a central beginning point with what you do with prospects and clients. And I guess secondly, why does it have that role? If it has a central role, why? Jeremiah, I thought that was actually a thing I'm not sure we even talked about on our other 4 sessions, was just the inflation adjusted aspect of it. And so, one reason you said you make it an important part is just it's pretty darn hard to find, kind of an inflation adjusted annuity essentially out there. In fact, I don't even know if they exist as commercial things. But I know you also kind of you have some other reasons that you've kind of made it part of the core. So if you want to address that, we can start with you, Jeremiah.
Yeah, absolutely. Thank you, Justin. So, kind of as I mentioned earlier, you're going to find it's going to be hard pressed to you to find any other source of retirement income. And that's all that we do in my firm is retirement income planning, right? So you're going to be really hard pressed to find any other source of retirement income that not only is tax efficient. So even with the big, beautiful bill, for our clients, that's what I've been kind of telling them. You're kind of fortunate in one hand is that you're not in the 88% who's going to get their Social Security tax free now, right? You've done a good job, you've saved, you've earned, you've had a good living, and so you're not going to qualify for it to be free, but you are going to be able to qualify to have that higher standard deduction, lower their overall, taxes on your Social Security. So at worst, it's tax efficient. Only 85% of it's going to be considered taxable at its worst, right? And so that is such a big tax savings. If you look at, we do a case study that we show in our Social Security and retirement planning seminars that, once you optimize and you delay, and it's not always just everybody go to 70, but, we use a variety of strategies just depending on, husband and wife, married, divorced, with, all the case. There's no general rules of thumb. I hate general rules of thumb, right? But once you optimize it, and whatever that means, it's individualized for each individual, client. You're going to see this shift in having the majority of their essential need covered by Social Security, so it's guaranteed and it's tax efficient and it's cost of living adjusted. And so then we can backfill with their 401ks, their IRAs, their non-qualified funds to make it with with the incredible software that we get a chance to have the ability to leverage, to provide them the most tax efficient, income in retirement that they can possibly have. And so I've seen the difference when I've run the numbers. It's a pretty substantial difference in the overall, success and projection of their retirement, especially as it relates to the taxes. And so everybody wants to save taxes, but they just disregard the fact that, the Social Security can provide a very tax efficient source of income. And personally, it's real personal to me. My mother was involved in a pretty dramatic car accident when I was 1 year old. And so she's literally been on Social Security my entire life. And I didn't realize it at the time, kind of how that affected, but now that I've realized that, and yes, my clients' lives are different than my mother's, the way that was it, but it's still coming from Social Security, right? And so just taking the opportunity to slow down, make that a focal point and make sure we're doing the best job for the client. Because as a fiduciary, that's what we have to do. What's in our best interest? So we can't just discount it and say, well, just take it, when you retire, and that'll be good. We'll take care of everything else. Maybe that is what's in their best interest. Maybe it's not, unless you run a full analysis on it. And so that's what we're all about here at Next Phase.
That makes sense. Matt, I know you mentioned you kind of made a shift to making Social Security your core, in the last, did you say a couple of years ago? I'd love to hear a little bit more about that and, well, that process and what triggered it.
Yeah, so just like Jeremiah, I appreciate the question, Justin. Just like Jeremiah, we're both very heavily focused on the seminars, and that's kind of where we begin our interactions with the clients, is becoming this educator, right? And I'm a big proponent of educating your client. I think it adds credibility. I think you're the authority in that relationship, and you can start to go ahead and fit into this role as an advisor even before they've even hired you, right? And so I think education is really kind of the pathway if you're trying to close more business. And you really have to kind of take an assessment of what are the big pain points that these clients have, these prospects, right? So these people that come to our seminars or that come into our office, what is the main thing that they don't know about, right? That we can move the needle as far as value goes. And for, I would say, over 90% of those, of the prospects that come into my office are like, hey, I just want to make sure I get this Social Security thing right. It's confusing. It's complex. It feels like, it's very cumbersome. I'd rather just have a professional kind of help me, kind of guide me through this process, right? And those are all things that we want. I mean, those are mindsets and behaviors that we want our clients to kind of look to us for, right? But we'd rather, kind of skip that part, or a lot of the traditional kind of advisors will skip that part and go straight to the assets or the annuities or whatever they're trying to sell. But it's a really good way to say, hey, I'm not going to charge you anything, right? This is just kind of a free offering to do an analysis from our seminar, at least the way that the way that we structure it. And we can kind of step into that role as being an educator, being an advisor, right? Building value on something that they need help with, right? And so that's the shift that we took, is why don't we just focus on this? We could add a ton of value. We could step into this role as an advisor and as an authority, as an educator in their lives. And then that should transition, and it has transitioned for us to where it's like they look at us for that continued advice, that continued guidance in their entire retirement plan. So it's just kind of a step one of the relationship. And it really kind of is conducive for us to, again, step into that educator role and be a credible authority in their life.
So I'm wondering, both you two and also, Mike and Derek, what sort of level of understanding or expertise on Social Security do people that you work with typically have when you first meet them? And are you trying to get them to a higher level of expertise in any way, or is it really just a matter of, a little bit of education, but it's about, you're the expert? I was going to ask how you personally become an expert, but obviously you go to the Income Lab Masterclass. I mean, that's the but yeah, I'm just curious. I know this is, not unscientific survey here, but what do you think people kind of tend to come into your practice with in terms of knowledge? Mike, maybe you.
Yeah, I'll go first if that's okay. I mean, mostly it's the surface level knowledge. Every now and then you get somebody who has kind of dug into the weeds, but still not really. I had a recent discussion with a client. I mean, we had the divorce webinar, or a version of this webinar, and I have a client who's divorced. She never earned enough credits to qualify for Medicare. She's 65. And she's dating this guy who's like, you need to file for Medicare. There's this huge penalty. First of all, penalty's not that huge in context of this client. But second of all, like, well, she doesn't have to file for Medicare until she claims on her ex-husband's Social Security. So it's like there's that sort of there are people who think they know a lot, and then there are people who they just want you to tell them. And if from my perspective, I prefer people to have the knowledge, so I want to go as far as they are capable of learning. Like I'm not gonna go into the weeds about how everything is calculated, but I want them to understand. People will typically understand at least for a short period of time, and then the next year that I talk to them, well, it'll be re-education, right? So it's just like anything else you do in school. If you're not constantly doing it, then you're not gonna know it.
Yeah. Anybody else have any response to that? What do you tend to see kind of out there in the world?
Yeah, from my perspective, very similar surface level. They're very confused. I mean, I have a handful of stories from meeting with prospects, and some are now clients. My favorite story I like to share is one of my favorite couples, and she too didn't, have enough credits to earn her own retirement benefit. Her husband had been retired for 18 months, collecting his Social Security. And until we had a conversation, they came to my seminar and then in turn scheduled a complimentary session with me. She had no idea, he had no idea there was a spousal benefit, which ended up being over $1,800 a month that she had missed out on for 18 months, right? And so they're just confused. In my opinion, it's on purpose, right? There's just so much confusion out there as far as how Social Security works, all the different ways to file, and as well as, is it going to run out? I think most people have just believed that the Social Security is going to go away. And so they just immediately jump at age 62 and file for it because they better get it while they can. And, for a lot of people, that might be the right thing to do. But for many folks, especially that have done a good job of saving and retiring, they in their mind, they link retirement with claiming Social Security, and it's just not the case, and it doesn't need to be the case for a lot of folks, especially that, as it would be meeting with us for financial advisors. It means they've got enough assets, right, to look at all the strategies, not just take it. And so there's just so much confusion out there around the different strategies, especially how to protect the survivor benefit, which is really at this point, a survivor is the only one that really has options. And there's some really good strategies they can leverage if they're aware of them, and so that's what I tell everybody. Look, you can't win a game unless you know the rules. So you need to learn the rules and know how to play the game.
So Matt and Derek, you mentioned you or have done, events, seminars, talking with people. And Matt, I like the way that you put it. You said, what are the pain points, I guess. So what sorts of things would you cover in, a seminar as opposed to working with, an individual, they're in your office and so on. So what sorts of things are, the areas that you would cover if you were using seminars, for example, as a method of connecting with people?
Yeah, I'll jump in on that one. I think for me, it's often, trying to give people education. So always want somebody to walk away from an event feeling like, okay, I learned something from that. That wasn't just a sales pitch of some kind. So really trying to educate people. But I think it does help to get into some of those more nuanced sort of situations that especially trip people up. Social Security tax torpedo, that's a common one where people just aren't expecting, oh, wait a minute, the way Social Security is taxed, if I actually take some additional money from an IRA, I might be paying a much higher tax rate than I really think. I think there's a lot of ways to cover that, and sometimes it's way too deep in the weeds and things like that for a presentation, but really just trying to, give people that information of like, okay, here are some things you really want to watch out for, or some things in your situation that might really be a red flag of like, hey, let's have a deeper conversation about this, make sure we get you pointed in the right direction.
And for those of you who are looking at, we've heard taxes several times. I know Jeremiah and Derek now. Session 2 of the masterclass was about taxes. So if you want to go back to that, and it's fair enough. It actually is pretty complicated. I mean, to the point where yeah, like Mike was saying, like sometimes you got to remind yourself, it's not just a straightforward 85 or 50. There's actually a, kind of a strange shape to how all that taxation works. So yeah, fair enough. That's a good way to go. How about you, Matt?
Yeah, I think for me, I think the seminar is really an opportunity for you to kind of get a little bit more into the weeds, be a little bit more factual. Again, you're an educator, right? So whenever they come into my office, I think the prospects and the clients, they value simplicity, right? Kind of just get to the brass tacks and say, hey, what should I do? Kind of what do I need to know, right? But as far as in a group setting, it's really an opportunity for you to showcase a little bit of your knowledge that might just be clunky and way too complex for you to try to do that in a client meeting, if that makes sense. So, we do a lot of case studies. We go into a lot of the facts, and, we don't spend a ton of time going super, super deep, but we just want to cover all the bases. And whenever you're wanting, or your goal is to have the client reach out to you and say, hey, I really would like for you to kind of take a look at my scenario and give me your best advice, right? There has to be a little bit of a mixture of credibility, right? They got to see the value in you, that you know what you're talking about, right? It has to feel a little bit more complex to them, right? It has to kind of feel like a little bit over their head for them to say, hey, you know what? We need to go talk to this guy because I don't want to have to figure this out myself, right? So I think there's a balance between how you're structuring your seminars, and that's just Jeremiah. Me and Jeremiah are best friends, and so I'm getting text messages from him. So I appreciate the distraction over there, man. So, anyways, so back to my train of thought. So you got to have a little bit of both for them to raise their hand to say, hey, you know what? I would like, I think we need to go talk to this guy. I think he could probably help us clear some stuff up. So I think on the seminar, a little bit more factual, showcase your skill set and kind of your knowledge base. And then whenever they get into your office and you're doing an actual consultation, then you can simplify it a lot more. You've already kind of, built your credibility and you authority as an educator, and you can kind of just, dial it down for their specific scenario.
Yeah, I think if anybody on this webinar is looking for those case studies, because I think both of you mentioned that's kind of a great way to do, if you're doing a presentation, case study is a good way to go. If you go back through the tax session we did, or the spousal, survivor, divorce, right? I mean, those are the areas where there is more to do. And as Jeremiah said, survivor benefits. I think that's actually one of the things I've gotten out of this series, is thinking a little bit more about survivor benefits at the beginning being an important thing, because often there will be a survivor who may live quite a while, and so that can impact your decisions. Won't always mean that should be your overriding consideration, right? But it's definitely something I've taken out of talking with a lot of advisors about this, is like, remember that could be also, it can be unexpected, right? We've also talked about that. And I think I just saw a comment in the chat saying, hey, isn't part of this also thinking about how long someone might live? So maybe some of your case studies could involve, living a long time or having someone die a little younger than expected, right? And walking someone through how their choices would impact, the survivor in that kind of situation. So if people are looking for, building their own or doing this kind of presentation, I think what I'm hearing is start with case studies, and, probably some of the areas that are a little bit more, complex, as Derek said, the tax effects, maybe they say, oh, I'm gonna, take out a bunch of money and buy an RV. Whoops, we actually just went from, zero taxation or 50% taxation to 85, right? Okay, those are the sorts of things that can come up. Okay. I know some of you have mentioned when we've talked in other places that you often will talk someone through break-even points. So just to remind people kind of what that even looks like. This is from our first session, but I think it was either Matt or Jeremiah. They said that you make that kind of a key part of something you talk about with clients. So I'd love to have you kind of share with us how you do that, and how you make that part of the conversation.
Sure. Whenever I'm calculating, or doing a Social Security analysis for a client, break even is one of the most important things that I'm looking at. Excuse me. To me, if we're trying to decide between 65, whenever they're going to retire, 67 or 70. Now, we all know that the longer they defer, you're going to get a higher benefit. But if you calculate that break even point, and they've got a life expectancy, their family history, dad's living in 95, mom's 92, there's just a high likelihood that they're probably going to live a long time. You could make the case for, hey, we should defer till 70, or we at least need to consider that. But, the way that I look at it, if we're going to defer 3-4 years, that's going to put a lot of pressure on their overall investment accounts. And then whenever we do the break-even calculation, if it's going to be somewhere between 81 and 83 years old, it's really hard for us to make the case on why we would want to defer, and put all that extra pressure in that first 10 years where they're probably going to do the majority of their spending for their bucket list, their travel, all their dreams, right? So for me, it's more of a conversation. Now, if we need to defer to kind of enhance the overall survivor benefit, and that's definitely something that we'll take a look at. But on average, our clients, they do the majority of their spending between, 67 to 77. Once they get into the 80s, their spending really kind of levels off. A lot of their expenses baseline, their houses are paid off, their cars are paid off, and just, life is a lot less expensive. So for us to defer out and make it more complex on the front end to get a higher benefit, and it's not going to financially benefit us until we get to this 82, 83 range where we know statistically they're probably not going to be spending a whole lot. That's a pretty tough case for us to make. And I'll just add this into it. Most of my clients that come in, or most of my prospects that come in, they're already thinking, all right, I'm gonna file for my benefit at my retirement age, right? Like Jeremiah said, sometimes that's not the best, that's not in their best interest. Sometimes it is. But if it's not going to move the needle a whole lot, I've tried to kind of push people out when, pushing out could have enhanced their overall plan a little bit, but it's not going to move the needle a whole lot. And it's just, sometimes if they're planning on retiring at their full retirement age at 67, and their plan is going to work either way, a lot of times just path of least resistance is saying, hey, listen, let's calculate the break-even point. As long as you understand that we could have a higher benefit, but it's not going to benefit us until after we turn 81, 82 years old. As long as we all are on the same page, then let's go ahead and kind of move forward with filing at your retirement age. So that break-even point to me is a big factor on whether we're going to defer, whether we're going to file right at their retirement age, and what kind of overall needs we have in between there. But again, expenses drop, baseline, life gets a lot less expensive. And it makes it a little bit more complex on the front end, that obviously can add more workload as an advisor and a little bit more complexity to the client.
Yeah, that's actually, I hadn't thought about the break even in something kind of came to my mind as you were talking there. So let's take a look, for example, here, you talked about 67 versus 70, and this is just a random example, right? Where somebody has 1,000, if they took it at 62, at 67, that's 1429, at 70, it's 1771. And as you said, say their break even was whatever, 82. The first month after their break even, they now have $300, 350 more than they would have had if they had claimed at 67. But for those 3 years, they had to have more of their funds coming from their portfolio. And we've talked about that concept a little bit more before, and I'll return to it in a second here. But I think it's also important to note break even is just, it doesn't mean suddenly everything is much better. It's just, okay, that next month you got a little bit more than you would have otherwise. And so it's really, to your point, Matt, now if somebody has good expectation of living into their 90s, maybe that is an overriding reason that, hey, that extra 350 every month for the next 20 years, 25 years, that's a big deal. Whereas for others, if their life expectancy is more like 83, well, I mean, this is not a major issue that we have to obsess about. But back to your point, Matt, about kind of how you think about phasing spending, or maybe it's just the way you talk about it with clients. I thought that was an interesting one. I think it's come up also on the psychology session that we had 2 weeks ago. But you're maybe share a little bit more about that philosophy of how you split the plan up into, is it basically the first 10 years and the next 10 years, or how do you think about it?
Yeah, statistically, the majority of retirees are going to spend the most money in the first 10 years. That's whenever they've got their bucket list, they're going to want to do their traveling to Italy or take their grandkids to Disney or whatever the case is. So, and typically if they have a mortgage balance, usually there's about 10, maybe 15 years on that at the most, unless they just bought a house, which is normally rare at that age. So the reality is we've got a high amount of spending on just fun stuff, right? We want them to go enjoy their retirement. We want them to spend the time with the grandkids, do all the things that they kind of envision themselves doing, and we want to help them do that. But that's typically going to happen in the first 10 years. When you combine that with the reality that the majority of their debts or their expenses are going to be either paid off or reduced, then you can pretty much make the case that life is going to be a lot less expensive when they get into their 80s. So on a planning basis, we typically try to make sure that we have the most cash available for those things in that first 10 years. And we want to budget that out into our income plan. And then we separate kind of like this later growth bucket that is not part of the income plan, but it's just compounding. So then we're going to leverage the rule of 72. And we understand at some point in time that account's going to double, right, based on the rate of return. So as long as we can segment out our overall finances and every dollar is kind of has a job almost, to where we know how much our budget is, we're going to go ahead and budget out this amount of our assets for this first 10 or 15 years where we know we're going to be spending the most. And then we've got a separated asset class or a bucket of money that its job is just to grow and compound. That puts us in a really nice position to where if life does not get less expensive and it just kind of continues, we're still prepared for that, because that later bucket of money that's just been compounding is there for us to now reallocate to an overall income plan. So we use a lot of lifetime guaranteed income annuities. So as long as we can structure out the correct Social Security plan, we add that to a guaranteed income annuity, we've got the foundations of a really nice income plan that is insulated from the overall market. And then that means that we can be a little bit more growth minded with our overall later bucket that's not a part of our income plan. It's still available for us to do fun stuff if we need it, but its job is just to grow. So if we segment those, if we separate the client's assets into dedicated timeframes of first 10 years, second and third, the client starts to get a really clear vision. And what happens is the byproduct of that is you actually give the clients confidence to go out and spend. Because if you've been doing this for a while, if you've got all your assets in one bucket, even if you've got $2-3 million, a lot of times those prospects or those clients are scared to death to spend their money because they just don't want to run out, right? And they've kind of been conditioned to just kind of budget things out. So as you structure it appropriately, it starts with Social Security. You got to get that right, and then you start layering in the income plan on top of that. Clients start to get a lot of confidence because you're providing clarity.
That makes sense. Yeah. I think this concept of sort of phases of life, what you're spending, and this feeling about, permission to spend, we've hit on before. I know Mike and Derek, you may have talked about this 2 weeks ago in the psychology webinar, but sort of how have you seen that play out in terms of how Social Security affects how people feel about their spending? Because often they come into retirement in general not really knowing how to spend from something other than a paycheck, right? It feels pretty awkward to suddenly start spending your own money. So how have you seen that play out? And we'll start with you, Mike.
Yeah, it's different, right? So it's one of those things where you kind of have to get out of your own head as a financial expert and put yourself in the shoes of the retiree, because there's so many different thoughts that could come from that. Most of us are trained to think of money as fungible, right? So it's just, it doesn't matter where the money comes from. It's all money. But people they do value certain things more or less. Social Security is one of those things that people may value less, right? Because some people might think it's going away. And so they want to claim as early as possible, start spending, whatever it might be. And then rather than touch their own assets, so hit that first, and then whenever the political bomb happens, poof, at least then they can rely on their savings. Then there are the people who are like, no, that's I need to make sure that is the most I can possibly get. That's my best option at a comfortable retirement. And so a lot of this is actually, spending time talking to people about, why do you think that? Tell me where this is coming from, which is not necessarily the most, that doesn't happen all the time particularly in a discovery meeting, right? A lot of people don't, you're just trying to get the facts. not the feelings, except that the feelings are facts. So I try to spend a lot of time, digging into like how they think about all of these things. And I think to both Jeremiah and Matt's point, I mean, you get clients who it doesn't matter what their investable assets are. They're going to have different opinions on Social Security. They might have 5 million, 6 million, $7 million, and Social Security is really important to them, and you need to spend a lot of time talking to them about Social Security. And so I think it does matter the client, right, and where they're coming from. And so psychology, the psychology plays into it from their perspective. You just have to get there sometimes. And a lot of times they come to the financial person, they're like, well, you're just a numbers guy. And of course, nothing could be further from the truth. Like we have to have those social emotional skills in order to help move our clients.
And they might also assume you're just the investment guy, which I think several of you have mentioned, like, making sure people understand now a financial advisor and a financial plan is about a lot more than, how you invest your money. So, I had just a small question, and I see some people kind of chatting about, net worth of people who have financial advisors and so on. And this sometimes comes up, like, do you think, is there a point of like a net worth point where like Social Security kind of doesn't matter anymore? Or in your experience, do you find, I mean, I'm sure there is, right?
Yeah.
Elon Musk probably doesn't care about Social Security, right? But like among people who have financial advisors, is it, after $1 million, it doesn't matter? Is it 10, 20? Like what in your experience have you found, if there is such a point?
I think that number is really big. Maybe 30 million, maybe. I will tell you very recently, I onboarded a couple, $10 million net worth. And we spent the most time talking about Social Security using, we were in prototype mode with the Income Lab tool, spending a lot of time with that tool, because, ultimately it was enough of a chunk. They both worked their whole lives, enough of a chunk of their retirement income that it was important. It was important, so we needed to have the conversation about, when are you going to claim? What makes sense for you as a couple? Survivor benefits. In this particular case, they both expected to live a very long time. But when we did the scenario planning, we killed the husband first, and he had a slightly higher Social Security. So we wanted to have a conversation about that. I think that it is a high number where people don't care about Social Security.
Yeah, if you don't mind, I think that was a very valid point and something that came to my head. Let's think about this for a second. The people with a higher net worth, they pay the most into Social Security, and they also they guess what? They save the most money, so that means they care the most about how the money is spent and how it works. And so, I think that is, he described it well. That person with 10 million, but they spent the most money because they want to get the most out of it. If I pay the most in, I want to get the most out of it, right? And so we want to make sure we take advantage of that. I don't know what that number is because, for our firm, we kind of focus on what I like to call the middle America, middle market, right? But and so it's such a vital piece of the overall structure. But to me, if the money's there and it's your money, you earned it, then why not let's do the best job we can to take advantage of it? Because that's less that you have to spend on your own, more you can give away, more that you can do for legacy, things of that nature. So I think it's why it's pretty vital for everyone. I mean, some people just don't care because they have enough. It's just, it is what it is. But I would say that's very rare. It's not common.
No, it's a good point about the, generally the benefit number is going to track a little bit with their assets, because if they amass those assets by making money, right? And paid into Social Security. I think somebody just said, yeah, the max it is around 5,000. I forget what the actual max is, but now you're also really starting to look at, oh, okay, say it's 5,000 and maybe, even more between the two of them. Now taxes are a much bigger thing, right? I mean, if you get $1,000 a month, okay, tax is probably not as big of a deal, right? So now all these things actually come into being even more important, and survivor benefits and spousal, right? So as that benefit gets bigger, that's a really, really good point. All right.
Justin, if you
Sorry, go
don't
ahead.
mind, just going back even one question to the how people think about how
Hmm.
Social Security fits in. I actually had an interesting anecdote just this last week, where I had a client who we talked through their plan a lot. They were somebody who could spend a lot more than they wanted to spend. I think, they could, even with the settings kind of on the most conservative in Income Lab, could spend about 12,000 a month. They only wanted to take about 8,000 a month, for themselves. And I've been pushing them, you can spend more, you can spend more. Every time we meet, we have this conversation. And they want to claim Social Security early, but they remembered back to a conversation. They're like, well, you said, like when we start taking our Social Security, then we take less from the portfolio and all that. And I was like, well, yeah, but that was before, you know, assuming you were spending at your maximum capacity. And they were like, well, what if we just take our Social Security early and then we don't have to drop ours? We'll keep taking the portfolio spending, but we'll do that. And so I just thought it was really interesting. They were willing to take their 12,000, with 4,000 coming from Social Security, and 8,000 from their portfolio, but they were just unwilling to take the 12,000 from their portfolio. So it was one where, yeah, I was like, okay, if that's going to get you to spend at the level you can spend at, let's turn it on right away. But just interesting how people think about that.
Yeah. Yeah, that's really interesting. I mean, it is like I think it's called mental accounting, right? Where like money that comes from one place feels different than money that comes from another. So just as you said, they're able to kind of they can take the withdrawals, or so they can spend the money if it's not from a withdrawal. And actually, I just since this is a new thing, I'll share it with let me see here. Let me make sure I've got it. There is a new way you can actually show those withdrawals. So Derek, you and I have talked about this before about the retirement hatchet. This idea that you know the withdrawals make up for any for the needed income before you claim Social Security. But other than there is a view where you can show that. And let me see if I can pull it up here quick. And you can show it side by side and give people a feel um, for how that differs. So I'll show that and then we'll get to some of your questions. I know that a lot of people are waiting those. All right. Yeah, here we go. Let me share. Okay, so this is what I've done is this is an Income Lab, and I'm inside of the retirement stress test. This is also available from inside of Decision Lab, which is where our Social Security tool is. But I just have a plan. It's $1 million and Social Security. So very simple plan. And I just built one that's claiming both people at 62, another one both people claiming at 70. And I'm comparing them in one graph, and I've kept the income pretty much the same, actually, I think identical here. But if I switch over to the withdrawals, I can see how the one where I'm claiming at 62, they stay roughly the same as time goes on. Whereas when we both claim at 70, we have to take a lot more early and then it drops. If I switch that to the withdrawal percentage, which sometimes people are thinking about, you can see, okay, we have this long period where I'm gonna have to be taking, by the way, this is running them through from 2007, so global financial crisis. And it's just like, what does it feel like to take 12% withdrawals, during the global financial crisis? Well, I mean, in actuality, they would have been okay. It just might not have felt great. But you can also see here how, at least with this sequence of returns, taking at 62 would have meant they would have had a higher balance for obvious reasons because they were taking less from it, right? So, yeah, I think sometimes those psychological issues. I mean, in this case, it actually matches a real world math issue as well. But you can see how somebody might have felt better, or the clients you were talking about just feel more capable of following the blue line. It just doesn't feel as scary to them.
Justin, if I can just add, I think that's a really powerful visual right there. I just want to focus or maybe emphasize, your client's mindset and what they're comfortable with is very important, right? You might think that, hey, mathematically, the absolute best thing is X. And Y could be kind of accomplishing some of the things that they feel like are needed, or as far as timeline, I want to file at this age. That's totally doable. Like you can work it in their plan. But if they feel more comfortable filing at their retirement age, or if they just are just, set on filing at 70, both of those things are doable. I just think I just want to emphasize, if we think something mathematically is going to be the best case scenario for them, let's try not to conflict or be argumentative or to be a contrarian to kind of that, because at the end of the day, you're trying to help them, and you're trying to build their trust. You try to build, that confidence in your guidance. And sometimes if it's doable either way, maybe just kind of, be a little bit, just compromise some and work the plan out kind of where they're kind of dead set on. And because there's a lot of different ways to do things.
I thought that's great advice, and the topic of this is literally how to talk with people about it. So I think that's right on the nose, right? Like don't go in contrarian. There's one way to do it. The other thing I've noticed is a lot of times people's intuitions about things, which is going to come out as like their preference, that's not from nowhere, right? There's something they're thinking about, right? Could be longevity and mortality related, or something in their family. Could be, Jeremiah, like you said, this feeling of like, wow, man, I've made a lot of money. I was always at my, paying maximum Social Security, right? And those things, I think it was actually Zvi Bodhi who said sometimes when there's a difference between theory and practice, um, theory has a problem, right? Because like the practice, we're bringing all this stuff, like life is complicated, the world is complicated. We're bringing all this stuff in. Maybe the client or prospect can't really tell you why, but they do have that preference. And so the ability to like bend a little bit as an advisor, discover maybe some of those things, as Mike was saying, you'll actually suss out why those preferences are there.
If you don't mind, real quick, just to add on, and it's something I love the way Mike framed it earlier, talking about facts or feelings. I spend the majority of the time on the feelings. The facts are quick, they're there, we know the facts, but how they feel about their money and Social Security and retirement and their concerns, their fears, their dreams. If we spend the majority of time letting them know that they're heard, that, specifically around the Social Security, as long as they feel heard, and as Matt said, not trying to be a contrarian, but focus on the feelings, not necessarily all about the facts. I think as in the financial services industry, it's all about numbers and facts and all of that, but the feelings, that's where you win, and that's where the sale is made if we're talking about bringing on a new client, in my opinion.
All right, we've got just a few minutes left here, and I think we've hit some of these questions, but we'll we'll hit them real quick here. Somebody was asking about earnings adjustments. I'm sure for those of you, when you're talking with people about retiring before full retirement age, that's part of it, but actually absolutely take it into account. And yes, it does even impact survivors. Hopefully you don't have a lot of those situations where there's a survivor benefit before full retirement age, but it does happen. And so, yep, that's absolutely in there. All right. Looking for ones that are upvoted, if any of you are looking at them as well. Opportunity cost, that's something we haven't hit on today. We have hit on it in the past, but when I showed you that break-even example, that did not include any kind of discount rate or opportunity cost. And clearly there are good arguments that you should include those. I don't know anybody on here, Matt, Jeremiah, Mike, Derek, do you have a preference for how you do that? If you're trying to figure a break-even point, are you giving credit to the fact that a dollar today is worth more than a dollar tomorrow?
I can jump in and say, I mean, it's something I actually have longer Kitsis post coming in the future on that topic where I really try to dive deep into that. But I do think it's something that deserves more attention than it gets now. There are the people that argue it should be really a risk-based decision. Look at tips, use a 0% discount rate. I don't necessarily fall in that camp. People like Michael Kitces have argued it should really be more what the real return on your portfolio that you're instead taking distributions from. I think that's a good starting point, and I think you should actually even then think about other risks that are there when it comes to things like mortality risk or just the risk that somebody may not be willing to spend their money the way that would be ideal for them, and then that should kind of factor into it. But it actually makes a big difference in terms of if you use a 0% discount rate, a lot of times delaying is going to be the ideal, just purely from a math standpoint. If you get into like the real historical return on a 60/40 portfolio, maybe the 5% range, that's going to flip that around to oftentimes claiming early is the best. So I don't think there's any one right answer. It really depends on somebody's circumstances, where they'd be drawing income from, looking at all those pieces. Because if they have a tips ladder set up and that's what's going to fund Social Security delay, okay, maybe the tips is the right one. But for the way most advisors work with clients, I personally think more that what portfolio are you drawing from is a better starting point.
Right. So, and that graph or that slide I was showing you has zero, not because I think that's right, but just so that everybody could do the math really easily in their head if they really were on their calculator if they wanted to. But yeah, I mean, it's clearly a very complex thing. This example is essentially making I guess, the Michael Kitces point of like, hey, if if you're taking money from a portfolio, then the expected return from that portfolio is the right discount rate. And here we literally see that happening. So, and as Derek said, I don't know when that article is coming out, but lots of commentary there. But good question in there. I don't know, Jeremiah and Matt, do you talk about that kind of opportunity cost thing either in seminars or with clients or prospects when in the office?
I think it's a conceptual. I just want my clients to understand conceptually, all right? Because
Yeah.
I do think that, like you said, Justin, there is a case to be made, especially with that chart, is that if we turn on Social Security early, and I'm not a proponent. I know I've talked a lot about filing at your retirement age. There are certainly scenarios where we defer out to 70, right? But I think to just touch on that point is the more you can present it, especially in a seminar setting, as, hey, this thing is different for everybody, and this thing really needs to be customized to you and your family and your scenario, you're going to just get more opportunities to talk to people, even if you're dead set on like everybody should file a 70, right? But I do think that there is an argument to be made, or at least a case to be made, is if you're filing at 65, for example, not taking those withdrawals that you would have taken if we defer out to 70 and calculating that opportunity cost out until 70 and whatever that compounds at, I think that mitigates a lot of the potential, loss that an advisor might be looking at. Well, we're going to be losing so much benefit once they turn on at 70 because it's going to be a higher benefit. So I think that mitigates it a lot. And obviously that, however you're managing your portfolio, whatever returns you're getting, whether it's 6, 10, 12, whatever the case is, obviously that's different. But conceptually, I just want the clients to understand is that, hey, if we feel like this is the best route for you, if we're going to file at 67 or 65, I just want you to understand some of this opportunity cost. We're going to be able to compound some of this money over here that's going to be in our later growth bucket that we're not going to have to pull from because we're going to turn on Social Security a little earlier. So again, it's all customizable. Advisors might not agree with, kind of filing that early, but again, you really got to take what's important to the clients, kind of what they, what their expectations are. If they're already dead set on their mind. I remember I lost a client. I've never forgot this. I thought the best case scenario was for them to defer till 70. And the wife just could not. I mean, she had already planned on, and this was earlier, kind of in my career, she had already planned on filing at 67. And I didn't oppose her, wasn't argumentative. I just kind of kind of stood my ground and like, hey, I really think this is in your best interest. This is the way we need to go. And that was the one thing she just could not get over. And they had like $2 million, and it wouldn't have mattered one bit to their overall financial retirement success, if you would, whether she filed at 67 or 70. It was just a stake that I put in the ground that I was like, hey, mathematically, this is it. So again, you got to be flexible. I think that's really important whenever you're talking about Social Security, because some people do come into your office just completely committed to a strategy, right? And you have to value that. And but again, going back to, I know I kind of went off on a trail there, but coming back to the opportunity cost, as long as they can just understand conceptually, is like, we're going to be, even if we go with this, filing age, we're going to be able to kind of compound this amount of money that should mitigate any sort of kind of future loss. So again, just a case to be made for that.
Well, given that we have four people with, decades of experience, and you all seem to agree, like take clients seriously on these things. Don't be dogmatic about it. I think that's probably a good place to end. I know we did have a few questions. Some of them were fairly technical about, phasing withdrawals and so on. Those are all great questions. We just weren't able to get to them today, but probably think we'll handle on future webinars. So I'll just end by thanking Jeremiah, Matt, Derek, Mike for taking part in this panel. I hope everybody found it helpful, and we'll see you all again soon. Thanks very much.